All right, before we jump in, let's get our standard disclaimer out of the way. Everything you're about to see is purely for educational purposes. This is absolutely not financial advice, and you should always do your own research. Okay, let's get into it. Today, we are not looking at charts and guessing about price. Instead, we're going to pop the hood and look at the engine of an automated defense system that's been running 24/7. We're talking about a $60,000 shield and a critical moment the data says is happening as we speak. So let's start with the big number, $59,820. Now, to be clear, this is not some future prediction. It's not a what if. This is the actual amount of real money, USDC, that PLAZM's defense protocol has already spent buying its own token right off the market. And the how is what's really fascinating here. This wasn't one big splashy purchase. Nope. It was a tiny little drip, an automated buy every 10 minutes, day and night, for 133 days straight. When the market was crashing, it was buying. When it was rallying, it was buying. The machine just kept going. So here's our game plan. First, we'll unpack the two different engines that make this whole thing run. Then we'll get into the nuts and bolts of the constant buying. The main event, though, is part 3, the crossover, which is happening right now. After that, we'll zoom out to see what this means long-term and why this hidden infrastructure is the real story here. To really get this, you have to understand a crucial difference. This defense system isn't just one big bucket of cash. It's actually made of 4 separate pools, and they fall into 2 very, very different types. Think of it like this. On one hand, you've got the sustainable defense. This is the core. It's funded by tiny fees from bond trading. It's designed to be perpetual, right? As long as there's activity, it keeps refueling itself. On the other hand, you've got the finite defense. This is funded by user entries. It's a fantastic boost for sure, but that well can eventually run dry. And this table lays it all out. See those top 2 pools? That's the sustainable backbone we were just talking about, funded by that bond yield. One of them buys tokens to burn them. Poof, gone from supply. The other buys tokens to build up liquidity, making the asset more stable. Now the bottom 2 do the exact same things, but they're the finite ones. The huge takeaway here is that those USDC pools, they're the engine built for the long haul. So let's talk mechanics. How do these pools, especially the sustainable ones, turn that slow drip of yield into what's basically a constant wall of buy pressure? It's a beautifully simple loop. Every 10 minutes, the system triggers a swap, a buy. And since there are 4 pools all doing this, that adds up to 576 automated buys every single day. It creates this baseline of demand that's always there, no matter what the rest of the market is doing. Now, each individual buy is tiny. We're talking a few bucks. But you add them all up, and just the sustainable USDC pools are putting about $958 to work every day. That's nearly $7,000 a week. At the current rates, that's on pace for around $350,000 a year. So, okay, 60 grand deployed. But what did that money actually do? Well, it paid to burn 1.33 million tokens, permanently taking them out of circulation. It also bought another 1.34 million tokens and added them to the liquidity pool, building a stronger foundation. And maybe most importantly, it's just been there, buying, day in and day out for 133 days. And that brings us to the main event, the entire point of this deep dive, the crossover. This is that moment where the automated sustainable buy pressure starts to flat out overwhelm the sell pressure coming from token releases. You can think of it like 2 opposing forces. You've got the buy pressure over here, that $1,000 a day, and it's structurally designed to grow. And on the other side, you've got sell pressure from releases, which is structurally, permanently designed to decline. These 2 forces are heading right for each other. And right here, this is where the math gets absolutely wild. Just look at this with me. Today, day 133, that $1,000 in daily defense yield covers the estimated sell pressure by 175%. Pretty good. But just watch what happens. 3 days from now, it jumps to 372%. The day after that, over 500%. And then, look at day 139. 952%. Let that sink in for a second. That means for every $1 of estimated sell pressure coming onto the market, the automated defense system is standing there with over $9 of buy pressure ready to absorb it. The entire dynamic is flipping. Now, we've got to be completely transparent here. These numbers assume a 30% sell rate and today's prices. If those things change, the exact numbers will change. But don't get hung up on the specific percentage. The key takeaway, the thing you can't ignore, is the trend. One force is getting weaker, the other is getting stronger, period. So let's zoom out. What does this convergence really mean for the future? What's the long-term trajectory here? Well, as you can see, the sell pressure isn't just declining, it's on a permanent downward slope. This is baked into the code. We went from a 173,000 token release back on day 84, all the way down to just 9,000 on day 139. This force is mathematically programmed to just wither away over time. And this simple chart, this is the entire story in one image. You have the release pressure line, which is designed to go down forever, and you have the defense yield line, which is designed to go up forever as more bonds generate fees. We're witnessing them cross right now. The whole system was built for this exact moment. So that brings us to our final point, the big strategic takeaway from all this data. It really comes down to focusing on what matters. Look, the daily price is noise. It can be a huge distraction. The real story, the signal, is the infrastructure running underneath. Nearly 60 grand deployed, over 8,000 bonds working to generate yield, $1,000 in sustainable buys every single day, 576 automated swaps 24/7 for 133 days straight. This machine does not care about fear or greed. It just runs. And when you really see these two forces, one structurally dying, the other structurally growing, you realize the whole question changes. It's no longer a question of if the buy pressure will permanently overtake the sell pressure. The data is screaming that the real question is just when. $59,820 deployed automatically every 10 minutes for 133 days. Through crashes, through rallies, through flat days, the defense never stopped. And now, with releases dropping to 9,000 tokens a day while yield holds at $1,000, the math is crossing. This isn't theory. This isn't a projection. It's the data in real time. That's the shield, and it's about to become the sword. And that's our deep dive for today. Thank you so much for joining us. Please remember, this is all for educational purposes. It is not financial advice. The crypto space is inherently risky, so please never invest more than you are willing to lose, and always do your own thorough research.